The average 401k balance in America right now sits at $148,000. The median, the number that actually reflects what a typical person has, is $38,176. That gap alone should alarm you. But here's the part that almost no one is talking about. We are sitting right now in 2026 at the second highest stock market valuation in 140 years of recorded data. The Shiller-Cape ratio, the metric Nobel economist Robert Shiller uses to measure whether stocks are expensive relative to a decade of inflation-adjusted earnings, just came in at 41.6. The only time it was higher was December of 1999. You know what happened next. And unlike 1999, we also have 75 million baby boomers either already in retirement or crossing the finish line right now, sitting in the mathematical window where a bad year doesn't just cost them money. It cost them the retirement itself. That's three simultaneous threats converging on the same generation at the same moment. And the people most at risk are not the panicked ones. They're the ones who did everything right. Stay with me, because I'm going to show you exactly how the mechanism works. Not just that the market is expensive, but why expensive markets are specifically mathematically catastrophic at this exact stage of your financial life, and not at any other. This isn't a market timing video. I don't do those. This is a structural video about a trap that is baked into the architecture of the 401k itself, and why 2026 activates it in a way that hasn't happened since 2008. Here's the frame I want you to carry through this entire video. Think about a ratchet wrench. You know, the tool turns one direction, clicks backward, without doing anything when you reverse it. During the 30-year accumulation phase of your career, your 401k works exactly like that ratchet. The market crashes, you buy more shares cheap, the ratchet winds back, then forward again with more force. Every bad year during accumulation is secretly a good year for your future self. The math on this is real, and it's actually beautiful. But at the moment you retire, the moment you flip from contributing to withdrawing, the ratchet breaks. There is no more click back. Now, when the market drops and you sell shares to pay your bills, those shares are gone forever. They can't participate in the recovery. The ratchet only goes one way, and it's the wrong direction. Every single bad year now costs you twice. Once in lost value, and again in lost recovery capacity. I'm going to call that moment the moment the ratchet breaks the switch. And in 2026, more Americans are hitting the switch than at any other point in the last decade. And they're doing it at the worst market valuation in a generation. In a few minutes, I'm going to show you something that will change the way you look at target date funds permanently. But first, let me show you why what you think is diversification inside your 401k is actually a concentrated bet you never agreed to make. Here's the thing about index funds that nobody talks about until it's too late. You buy an S&P 500 index fund because you want to own the whole market. Spread the risk across 500 companies. Sensible, boring, textbook. Except, as of 2026, 7 companies, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla make up roughly 33% of the entire S&P 500 by weight. 1/3 of your diversified portfolio is a concentrated bet on 7 tech stocks. And here's where it gets really interesting. In the first quarter of 2026, all 7 of those stocks were in the red simultaneously. The Roundhill Magnificent 7 ETF, which tracks them equally, fell 16% year to date by late March 2026, significantly worse than the Nasdaq's own 8% decline over the same period. Now you're asking yourself, okay, tech had a rough quarter, but I'm diversified across the whole 500 companies, so the damage is cushioned, right? Not if you're in a target date fund. And 63% of 401k participants at Fidelity had all their money in a target date fund as of the fourth quarter of 2025. These are the funds that are supposed to do the smart automatic adjusting for you as you age. The problem is that most target date funds are heavily concentrated in exactly the same US stocks and bonds that took the hit. Ron Surds, a retirement researcher who has spent decades analyzing target date fund construction, noted that in Q1 2026, the majority of target date funds suffered losses of more than 1% in the quarter, while more diversified portfolios with commodity and international exposure gained more than 2%. The difference in outcome from a single quarter, north of 3%. On a $500,000 portfolio, that's $15,000 in one quarter. And that's during a quarter that was merely volatile, not catastrophic. This is the part where the first ratchet click happens in real life. For a 40-year-old, none of this matters. The dip is a gift. For a 60-year-old who is 5 years from retirement, it matters enormously. Because we are now approaching what researchers call the retirement risk zone, and this is where the math turns genuinely dangerous. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. There's a phrase in retirement research that doesn't get enough airtime: the retirement risk zone. It refers to the 10-year window straddling your retirement date, the 5 years before and the 5 years after. Research by Wade Powell, the retirement income researcher who literally wrote the book on this topic, and Morningstar's own 2026 retirement income analysis are both explicit about it. The returns you get in this specific window can determine the entire arc of your retirement, regardless of what you accumulated before it. Here's the concrete math, because this is the part I want landing like a wall. Imagine two people, call them Alex and Sam. Both retire in 2026 with $1 million. Both withdraw $40,000 per year, adjusted for inflation. Over 25 years, they both earn the exact same average annual return of 6%. Same portfolio, same withdrawals, same average return. Alex hits a 25% market correction in year 1. Sam hits the same correction in year 10. Alex's portfolio depletes years earlier. Sam finishes in solid shape. The only difference is the order in which the returns arrived. Morningstar's 2026 retirement research confirms this. Two retirees with the same $2 million portfolio and the same 5% average annual return over 20 years can end up $1.7 million apart, depending on whether bad returns arrived early or late. Same portfolio, same withdrawals, same average return. One ends with $2.4 million. The other ends dangerously close to broke. The only variable is sequence. Research by Wade Powell goes further, estimating that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. The first decade is not one decade of 30. It's 77% of the entire story. And here is where 2026 becomes specifically dangerous. We are entering a high sequence risk environment with some of the most expensive stock prices in recorded history. A CAPE ratio above 40 is not an opinion, it is a measurement. And when the CAPE ratio has climbed between 35 and 40 historically, annualized returns over the following decade have typically landed in the low single digits, often negative in real terms. We watched this exact setup play out in the late 90s, when the CAPE peaked at 44.2. After that peak, the S&P 500 suffered a roughly 49% drawdown over the following 2.5 years, and then delivered a decade of essentially flat returns. 1999 retirees didn't just have a bad year, they had a bad decade. And the ones who were in their first 5 years of retirement when that happened, some of them never recovered. Now, you think the problem is market overvaluation, but actually the problem is something subtler and more controllable. Let me explain. The tension right now is between knowing these numbers and having a system that survives them. Knowing the CAPE is 40 is like knowing a storm is coming. It doesn't tell you when. It doesn't tell you how bad. It just tells you that your margins of safety should be higher. And your flexibility, your ability to pull back, adjust, absorb, needs to be built in before the clouds arrive. Here is the part that never makes it into a retirement calculator. And it's the reason I built a digital book called The Exit Code. Most retirement advice stops at save more or diversify better. But what actually determines whether you survive the first decade of retirement is the interaction between your withdrawal rate, your sequence of returns, and whether you have enough of a cash buffer to avoid selling equity into a downturn. The Exit Code is 8 chapters of actual retirement data analysis, 50 years of it distilled into a mathematical framework for figuring out your specific exit from the rat race. For this particular video, the two pieces that matter most are the dynamic withdrawal method, which is a structured alternative to the rigid 4% rule that lets you pull back in down years without derailing your plan, and the lazy portfolio. Construction, which has historically outperformed active management over 30-year windows by being boring in exactly the right way. It costs less than a dinner out, and it's available through the link in the description. Every year you wait to understand this, the compounding works against you, not for you. Now, back to the 4% rule. Because this is where standard retirement advice fails people in a way that I find genuinely absurd. The 4% rule was created in 1994 by financial planner Bill Bengen. He ran hundreds of scenarios across historical market data, 60% stocks, 40% bonds, to find the highest withdrawal rate a retiree could sustain for 30 years without running out of money. The answer was 4%. For decades, this became gospel. Max your 401k, retire at 65, take 4% per year, die with money left over. Simple, clean, comfortable. Except Morningstar's 2026 retirement income analysis, published with actual current data, puts the safe withdrawal rate for someone retiring this year at 3.9%, not 4%. 3.9. That sounds like a rounding error. It is not. On a portfolio of $500,000, the difference between 4% and 3.9% is $500 per year. On $1 million, it's $1,000 per year. But here is the deeper issue. That 3.9% number assumes a portfolio that is 30 to 50% in equities. If you're more stock heavy, which most people are, because most target date funds overweight growth assets, your actual safe withdrawal rate is even lower, because the volatility adds more sequence risk. Bill Bengen himself has revised his thinking multiple times. His current view, based on updated research, is that the rule was built for the retiree of the 90s, when retirement lasted about 20 years. But life expectancy has shifted. If you retire at 60 today, you might need your portfolio to last 35 years. The 4% rule was never stress tested for 35-year retirements at current valuations. The math doesn't close. You're playing a 35-year game with a 30-year map, and the terrain has changed. Here's a second problem with the 4% rule that almost no one mentions. The rule was built assuming your portfolio is held in a tax-deferred account, a traditional 401k or a traditional IRA, and that you'll owe ordinary income tax on every withdrawal. But it doesn't incorporate the effect of required minimum distributions. And this is where 2026 introduces a tax trap that is invisible to most people until it detonates under the Secure 2.0 Act. The age at which the IRS forces you to start withdrawing from your traditional 401k increased to 73 from 72 before 2023, and originally from 70 and a half before that. For people born after 1959, that age will jump again to 75, beginning in 2033. What this means practically: people who have been dutifully deferring taxes for decades now face a mandatory withdrawal schedule that will be calculated on some of the highest account balances in American history, because the market ran hard for the better part of 3 straight years before 2026. Here is how that trap works. Say you're 73 years old. Your traditional 401k grew to $800,000 through 2024 and 2025, 2 banner years for equities. Your RMD required minimum distribution is calculated on your December 31st balance from the prior year. So your withdrawal is based on the inflated number, not on whatever the account is worth right now if the market has since corrected. You take the RMD, let's call it roughly $30,000 based on IRS life expectancy tables. That $30,000 is taxed as ordinary income. It potentially pushes you into a higher tax bracket. It can trigger IRMAA surcharges on Medicare premiums. It can cause more of your Social Security benefits to become taxable. And if you happen to need that money during a down market, you're also selling shares at depressed prices to fund the distribution. The ratchet clicking permanently in the wrong direction exactly when the government is also demanding their cut. The Investment Company Institute reported that retirement plan assets across 401ks, IRAs, and other defined contribution plans hit $48.1 trillion as of the third quarter of 2025. Each 1% loss in overall market value is $500 billion in retirement wealth. Let that number sit for a moment. $500 billion for each percent. We're talking about the largest pool of retirement capital in the history of the United States, entering what could be a structurally low return decade, with the oldest generation of holders facing mandatory withdrawals from the highest balances they've ever carried. That is not a hypothetical. It is current arithmetic. Now here's the kicker, and this is the thing that actually keeps me up at night as someone with real money in these systems. A 2026 Vanguard report found that 6% of workers in their plans took a hardship withdrawal in 2025. That's up from 4.8% in 2024, and up from roughly 2% before the pandemic. That's the 6th straight annual increase since 2018, when Congress loosened the rules. The median hardship withdrawal was $1,900. The top reasons: avoiding foreclosure or eviction and covering medical costs. These are not people making bad decisions. These are people for whom the emergency fund is the 401k, because there is no other emergency fund. And every dollar they pull out early, before 59.5, gets hit with a 10% penalty plus ordinary income tax. They're losing 20 to 30 cents on every dollar to survive the month. They're dismantling the ratchet with their bare hands because the short-term pressure is greater than the long-term math. This is the behavioral trap at the center of retirement risk in 2026. Not just overvaluation, not just sequence of returns, but the psychological pressure that causes people to do the most expensive thing possible: exit the market at the worst possible time. Dalbar's research has consistently shown that the average investor underperforms the index by 3 to 4% per year. Not because the investments are bad, because the investor bails at the bottom and re-enters at the top, over and over across a career. Missing the 10 best trading days in a 20-year period cuts your total returns roughly in half. And the 10 best days almost always follow the 10 worst days. The people who panicked and left in March of 2020 saw those days. The people who stayed saw the fastest recovery in market history. And here is where you think the fix is just stay invested. But actually, the fix is more specific than that. Let me give you a real scenario. Meet David. He's 58 years old, works in manufacturing management in Ohio, makes $85,000 a year, and has been maxing his 401k contribution for 20 years. His balance as of January 1st, 2026 was $480,000. He has a Vanguard Target Date 2030 fund set for when he turns 63. He's done everything the conventional wisdom told him to do. He has roughly $240,000 in equity exposure through his Target Date fund, another $35,000 in a brokerage account, and basically no separate cash buffer for emergencies. Here is David's problem. He is sitting dead center in the retirement risk zone. The 5 years before retirement are the mathematically most sensitive years of his entire financial life. Every dollar he has in equities right now is more exposed to sequence damage than at any other point in the past 30 years. And in 2026, his Target Date fund, which should theoretically be auto-gliding towards safer allocations, still holds a significant chunk in US equities at a CAPE ratio of 41. His fund didn't lose money yet. But if the market corrects 25% before he retires, something that has happened an average of once every 7 to 9 years, historically, his $480,000 becomes $360,000. He then starts retirement with that number. And if his withdrawal strategy is built around the 4% rule and a $480,000 portfolio, and he retires instead with $360,000, he is immediately drawing at a 5.3% withdrawal rate on a shrunken base. The math no longer works. His ratchet just broke. And it's not because he made a mistake. It's because the risk zone is real, and nobody told him to position for it 3 years before retirement, not 3 months. The fix for David is 3 specific moves, not 20. 1, build a cash and short duration bond buffer equal to 2 to 3 years of planned withdrawals before the retirement date, not after. This gives him the ability to not sell equity in a downturn for at least 24 to 36 months, letting the market recover without touching principal. 2, immediately stress test his withdrawal rate against a 3.9% baseline, not 4%, because the Morningstar data for 2026 retirees is specific on this. A 100 basis point difference in starting withdrawal rate projected over 30 years is not a rounding error. It is the difference between running out at 83 or carrying money into your 90s. 3, model the tax interaction between his traditional 401k withdrawals and his Social Security claiming age. If he claims Social Security at 62 and simultaneously draws from his traditional 401k, he potentially pays ordinary income tax on a larger share of his Social Security benefit because of IRS combined income thresholds. Waiting to claim Social Security until 70 using a Social Security bridge strategy funded by non-retirement assets could increase his lifetime benefit by up to 32% and dramatically reduce the tax drag on his overall income picture. None of those 3 things are exotic. None of them require a financial crystal ball. They all just require running the math before the ratchet permanently changes direction. "I can deal with this later," said the person who retired in 1999. The market always comes back. It did. It just didn't come back fast enough to save their first decade of withdrawals. My target date fund handles all of this automatically. It handled the accumulation phase automatically. The distribution phase is a completely different mechanical problem, and target date funds were designed primarily for the former. Let me give you the 3 takeaways that are specific to this moment, not generic retirement advice, but calibrated specifically to the 2026 environment. First, run the concentration audit. Log into your 401k today and look at what percentage of your holdings is in a broad US equity fund or an S&P 500 index fund. If that number is above 60% of your total portfolio and you are within 10 years of retirement, you are carrying concentration risk that your fund label does not acknowledge. The S&P 500 is not diversified right now in the traditional sense. 33% of it is 7 companies. If those 7 companies reprice toward historical valuation norms, which they always do eventually, you absorb the hit at full weight. Adding international equity exposure, commodities, and short duration bonds is not panic selling tech. It's acknowledging what the index actually contains right now. Second, calculate your actual sequence buffer. You should have in cash or near cash equivalents, a minimum of 1 year of planned living expenses, and ideally 2 years. That is not in your equity portfolio. This is not your emergency fund. This is specifically your sequence of returns buffer, the money that prevents you from selling equity into a 25% correction in the first 3 years of retirement. Schwab's retirement research recommends 1 year in cash and another 2 to 4 years in high-quality short-term bonds for this exact purpose. If you don't have that cushion built before you retire, you are exposed to the most mathematically damaging single event in the retirement planning universe. Third, look at your traditional 401k balance as a pre-tax number, not a real number. If you have $400,000 in a traditional 401k and you are in the 24% bracket, you don't have $400,000. You have roughly $304,000 after tax. Your entire retirement income model needs to be built on the after-tax figure, not the pre-tax account balance you see on your quarterly statement. The tax is not deferred forever. It is deferred until withdrawal, and in some cases, it's forced by the government on their schedule, not yours. Understanding that distinction changes your Roth conversion strategy, your withdrawal sequencing, and your Social Security claiming decision in ways that are worth tens of thousands of dollars over a 30-year retirement. The financial advisory industry, for all its credentialing and paperwork, has a structural incentive to keep you fully invested in products that generate ongoing fee revenue. 1% of your assets under management per year, forever. On a $500,000 portfolio over 30 years, assuming 6% growth, a 1% annual fee costs you more than $170,000 in lost compounding. That's not a conspiracy. That's just math. The incentive is not to simplify your strategy. The incentive is to remain involved with it. Lazy investing built more fortune than crypto memes. Here is what I find genuinely amusing about all of this. In the way that watching a slow motion train carrying too many expensive bags toward a narrow tunnel is amusing when you're standing off to the side. The same generation that spent 30 years being told to set it and forget it in their 401k is now discovering that forget it worked great during accumulation and is a liability during decumulation. The ratchet changed directions. Nobody updated the instruction manual. And the most dangerous part isn't the market valuation, or the Magnificent Seven rotation, or even the RMD trap. It's the combination of all three arriving simultaneously, precisely when the largest cohort of American workers in history is crossing the line from accumulation to withdrawal. The machine was designed for a different era. You're still running it.